Hello guys, welcome to another strategy video in Options with G channel. This is JR. Let's go through the strategy for 2024. So the strategy what I am going to present to you is a calendar diagonal spread strategy. We have initiated this strategy on 1st of December, or consider like 30th of November we have taken for the first week of December. So the strategy will look like this. We are going to buy a long-term call and we are going to sell a short-term call against it. If you want to know how the strategy is done, there is a strategy video for this which is called the Ultimate Guide for Calendar and Diagonal Spreads. If you want to watch the full video, strategy video, the link will appear on top of your screens now. You can click the link and watch the video. So what this strategy is all about? We are going to buy 26th of December 2024, not 2023, 2024, which is a next year expiry. We are going to buy 20,000 call option and we are going to sell the near expiry, which is the next week expiry higher call. Okay, so the premiums what are taken is not arbitrary premium. So for this there is a calculation is there. If you want to see the calculation, there is a sheet which gives you the calculation. This sheet, Google sheet link is also shared below in the description. You can click it and download it for yourself. So what we are going to do is we will buy a leap option which is expiring at 26th of December next year 2024. Okay, and the short option sell is on 7th of December 2023, which is next week. Okay, the date initiated for this strategy is 30th of November and the premiums are here. What we purchased is a long-term option single lot 50 quantity and we have done it for 1875. It was 1892, but then I put a limit order and got it executed at 1875, and against it we have sold a near expiry 27th of December 2023, sorry, 7th of December 2023, 2450 CA. 20,000 is a in the money call. Against it I am going to sell a out of the money call. I have to get a premium of about 42 rupees to 46 rupees. So which is like two options I have got based on the number of weeks left. Between these two, the number of weeks left is about 56. So if I collect entire 56 weeks, if I am going to collect the premium, I have to collect 42 rupees every week so that I can expect a return of 25% on this capital deployed. What the premium I paid for buying this option, in this I want 25%. So 93,750. Say I have put in about 1 lakh rupees and I need 1,25,000 rupees back in a year. So that is like 25% return. So if I have to do that, I have to collect a premium of 42 rupees every week if I am going to collect for 56 weeks. Or if I have to collect only for 51 weeks, means I want to come out by next November end, means I want to do this for 1 year. In the last month of the expiry, these options will have a lot of time decay will happen. So I have to come out before that. So I am keeping 51 weeks. So if it is 51 weeks, when this series will end, this series will end in the 30th of November 2024. So the options what we are having in December will still have 1 month left, right? So we can escape slightly from the time decay happening, the huge time decay happening in the last week, last month of the expiry. Okay, so to do that, we got the formulas, everything is around here. Even when you download the Google sheet, you will find all those formula. This is not rocket science, this is simple mathematics only. So the minimum weekly premium what I need to collect is about 42 rupees to 46 rupees. So what I am doing is I am collecting 44 rupees. How I am collecting? I am selling double quantity of 22 rupees. This is slightly risky. If the market goes up too much, then we will have a bigger loss here than the gain what we are going to have here. Right now the market is bullish. I don't want to sell only 50. I'll be selling very, very close to the money, like 2450. The market, when I entered, the market was at about 20,050, right? Means it was somewhere close to the all-time high. So now it has already crossed the all-time high and it is trading as 2267. It is not visible here, but it is 20. Let me just refresh this so you will get, yeah, 2267.9. So when I entered this strategy, it was around like 20,050. Means not, now it has gone up by 200 points. So if I sold somewhere 44 rupees option, if I wanted to sell couple of days back, right now that option would be in the money. The loss would be somewhere about the same. Okay. So but if you see the beauty, the short-term option, since the market has gone up, this is trading at a loss. This premium has doubled, more than doubled. So it is trading at a loss of 2,600 rupees. But you see the long-term option, our buy price is 1875, but it has crossed 2,000 rupees. So now this has gained 8,250 rupees and we have a short-term loss of 2,655 rupees. So put together, the strategy is currently, this is only 2 days of entry in the market. Just I have entered it into 2 days before only. So it is already trading at about 5,600 rupees in profit. So the payoff will look like this. Everything is same, since the maximum loss will be given unlimited because we have sold 2 lots. This means against buying of single lot, we have sold 2 lot. That is why it is giving unlimited. But consider that the market is not going to hit the upper circuit every day for next 7 days. So it is not an unlimited loss. You consider it is an undefined loss. Even the loss comes for us, the loss will come after. Where is the break even? Upper break even is 2764. Right now we are at 2269 or something. So we have another 500 points, means in next 5 days for this strategy to even break even. If it is within that, we will be ending up in profit. Okay. The reasonable break even for us is 2450 plus 22, which is 2472. So if the market goes above 2472, we will make loss in the weekly option, but your long-term option will be in a quite high profit that time. If you want to choose to close, you can choose to close, but generally I don't do it. So what I do is I will take the short-term loss. Since the market is up, this option is deep in the money and I will always have some value here. So every week I will start selling some calls against this. This is considered as a deep ITM option. So you don't have to worry too much about it unless until the market comes below 20,000 and this becomes ATM or OTM, then we have some trouble. Otherwise, we should not have much trouble on this. Okay. So apart from that, there is nothing. I just wanted to share the trade. So all these strategy and the calculations are already explained in the original strategy video, which is called the Ultimate Guide for Calendar Spreads. Okay, calendar and diagonal spreads. So currently what we have taken is a diagonal spread 20,000 long-term option buy and weekly higher call option sell. Okay, this is the strategy and this strategy is suitable for the low VIX environment. Right now the VIX is at around 12. So now from here, if the VIX starts increasing, then this value will start increasing like anything. The long-term option value will start increasing like anything because we are paying a low premium due to low VIX. If the VIX is higher for the same index value, the premium will be higher because VIX is basically a measure of volatility. If the volatility is higher, the premiums are higher. So now the VIX is 12. So if the VIX goes to 15, even the market does not move from here. If tomorrow the VIX goes to 15, the market is still the same. This option will be easily 2,300 to 2,400. Okay, means that is the difference. And these trades, calendar trades, are Vega trades. Okay, Vega is basically your VIX only. So these are Vega trades. So if your VIX is lower and if the VIX is increasing, then these calendar trades will give you good profit. Okay. So just I'll give a minor explanation only on this, because if you go into the option Greeks too much, you will get confused. So just you have to understand that these calendar trades are long vega trades. You just remember that these are long vega trades. Means if you enter on a lower VIX and if the VIX is increasing, these trades will give you a good profit. Generally, I don't recommend this, like buying 50 and selling double the quantity if you are inexperienced trader, because you should know where to put the SL and you should know when to exit this. Okay, if you are not like 100% sure about doing this, just sell 50 quantity, but ensure that you are following this premium calculations. Okay, so if you are selling 1-to-1 quantity, if you are buying 50 and if you are going to sell 50 only, just try to get the premium on a Friday. Try to get this premium 42 rupees. If you get 42 rupees, it is okay. Okay, so that's it for today. So this is the strategy I wanted to share, and I will follow up on this strategy monthly. Okay, so right now I have initiated this trade. So what I will do, today is 2nd of December. So once the December expiry is done, I will make a video on this and we will make a playlist on this, and we will see means how this strategy is performing. Profit or loss does not matter. We will continue this and let us see means how this works out. We are entering in a right situation. The market is at all-time high. Right now, it will stagnate a little bit. Now the VIX is very low. Once the market starts going up, the VIX will also start going up. From low VIX, if it increases to a medium VIX to high VIX, this strategy should give a very, very good profit. Okay. So if there are troubles coming in this strategy also, I will explain in the monthly how I am adjusting. So I will explain. So if you are part of the broadcast group or the premium group, you will get regular updates every week. So the link to join the broadcast group is showing below. It is there on the video description also, so please click it and join. Okay, so that's it for now. Signing off, this is JR. May the markets be with you. Thank you. Bye bye. Thanks for watching. If you like our content, please subscribe to our channel, like and share the video. Thank you.